Welcome to this explainer. We are jumping right into the core concepts of financial management today. And look, instead of getting bogged down in endless accounting jargon, we're going to explore the business life cycle together. We'll trace the journey from that very first dollar invested all the way to tracking the literal wear and tear on your machinery.
So, here is our roadmap for the explainer. First up, the basic accounting equation. Second, business classifications and inventory. Third, we'll look at managing debtors and credit. And finally, calculating asset depreciation.
Okay, let's dive right into Section 1, the basic accounting equation. This is literally the foundation of the financial house.
Right, here it is, the absolute bedrock of all financial management. Assets equals equity plus liabilities. I mean, absolutely everything a business does has to balance on this core formula. Think of assets as the cool stuff the business owns, cash, buildings, inventory. Equity is what the owner has actually invested or kept in the business. And liabilities? Well, that's what the business owes to outsiders, things like bank loans or unpaid supplier invoices. Every single transaction, whether it's massive or incredibly tiny, hits this equation, and the two sides must always balance out. No exceptions.
Now, when you look at a real business, you don't just see a neat little math equation walking around, right? You see a messy, real-world list of line items. You've got 580,000 Rand tied up in land and buildings, 240,000 in inventory, long-term loans of 140,000. It's a lot, but here's the magic. Every single one of these messy items perfectly categorizes into our foundational buckets. The land, the warehouse inventory, those trade receivables, which is just money people owe you, they all stack up neatly as assets. The owner's 300,000 in capital, that represents the equity, and those trade payables and long-term loans just slot right into liabilities. By organizing all this everyday chaos into these three simple categories, you instantly gain like X-ray vision into the company's financial structure.
Moving right along to Section 2, business classifications and inventory. Let's frame the operational walls.
Obviously, not all businesses operate the exact same way, which means their financial focus is going to vary. There are four distinct types of business models we really need to get a grip on. First, a service business. They sell time and expertise. Think of a law firm or a local hair salon. Then you have a manufacturer who physically builds products from scratch. Next is a wholesaler who buys those products in massive bulk from the manufacturer and sells them to other businesses. And finally, the retailer. They buy from the wholesaler and sell directly to the end consumer, like you and me. The way these distinct businesses track their cash, and especially their inventory, is fundamentally different.
What's really fascinating to think about is the manufacturer. This isn't just about moving boxes from point A to point B. No, a manufacturer physically transforms resources right there on the factory floor. They take raw, base elements, add human labor and overhead, and fundamentally change them into something entirely new and valuable. That physical transformation, it requires a much more complex style of financial tracking.
Because of that complex transformation, a manufacturer can't just rely on one simple inventory account. They actually have to track a logical three-step life cycle. First up, raw materials. These are the basic ingredients sitting in the corner that haven't been touched yet. Second is work in progress, or WIP. This is the inventory currently moving down the assembly line. It's partially finished, and it's literally absorbing labor and electricity costs as we speak. Finally, it becomes finished goods, all boxed up and ready to be shipped out. Tracking inventory through these three distinct phases is absolutely crucial so the business knows exactly where its cash is tied up at any given millisecond.
Let's transition to Section 3, managing debtors and credit. It is time to track the money flow.
We often think of accounting as, just abstract numbers floating around in some cloud software. But maintaining strict, highly organized records of debtors, the folks who owe you money, and creditors, the folks you owe money to, is incredibly real. It often comes down to keeping literal, physical or digital files completely locked down. This is the actual lifeline of a business. You simply have to know exactly who is holding on to your money.
So, a really crucial concept here is the debtor's control account. Simply put, this is the total amount owed to the business by its customers. Think of this account as the heartbeat of incoming cash flow for your entire operation. It's a promise of future cash. Now, if this number gets super high, sure, it looks amazing on paper as a massive asset. But if those customers aren't actually paying their bills, your business is going to suffocate from a lack of actual cash flow in the bank.
And well, that leads us to a pretty harsh reality. Sometimes customers just don't pay. It happens. This isn't some academic vocabulary term, it's a very real-world business risk. To handle this, accountants use what's called an allowance for credit losses. Think of it as a financial safety net. It's a smart way for a business to look at its total receivables and realistically say, look, historically, a certain percentage of these people are just going to default. By factoring in this allowance, you ensure your balance sheet isn't overly optimistic. You're basically painting a true, conservative picture of the money you actually expect to collect.
Finally, we reach Section 4, Calculating Asset Depreciation. Let's account for that wear and tear.
Okay, before we hit the actual math, let's clearly contrast the two main methods businesses use to calculate depreciation. First, we've got the straight line method. This one is super simple. You apply a consistent percentage of the original cost equally over time every single year. Boom, done. Second, we have the reducing balance method. This one's a bit more dynamic. Here, the depreciation is calculated on the decreasing accumulated book value of the asset. So, as the equipment gets older and its value naturally drops, the chunk of depreciation you claim each year drops right along with it.
Let's walk through that straight line equation step by step, just so the logic is perfectly transparent. Imagine your business buys a fleet of vehicles for 500,000 Rand, and your company policy is 20% straight line depreciation. Well, 20% of 500,000 is 100,000, so your yearly depreciation is exactly 100,000 Rand. Easy. Now, if we're at the end of year 2, your accumulative depreciation is 100,000 from year 1, plus 100,000 from year 2, totaling 200,000. So to find out what those vehicles are actually worth today, the final book value, you just take the original $500,000 cost, subtract the 200,000 in accumulated wear and tear, and you're left with a realistic book value of 300,000 Rand. It's clean, it's predictable, and it's perfectly even.
Now, let's see how that reducing balance method shifts the math completely. Let's say you've got some equipment with an initial value of 300,000 Rand and a policy rate of 10% on a reducing balance. If you already have an accumulated depreciation of 30,000 Rand from a previous period, you don't calculate your next 10% on the original 300,000. Actually, wait, let me be precise here. You first have to subtract that 30,000 to find your new reduced book value, which is 270,000 Rand. Then, and only then, do you calculate your 10% against that new lower number. This method is brilliant because it matches the reality of things like technology or heavy machinery, which lose a huge chunk of value early on, but then degrade a lot more slowly as the years go by.
So, we've unpacked the core equations, inventory cycles, credit allowances, and even the math of wear and tear. And it leaves us with a really fascinating final question. Do these seemingly rigid accounting formulas actually tell the fluid, dynamic story of your business's true health? Well, the answer is a resounding yes. They aren't just rote math you memorize for a test. They are a living, breathing language. When you actually know how to read them, you can anticipate huge risks, maximize your cash flow, and ensure your business doesn't just survive, but totally thrives. Thanks so much for exploring these frameworks with me in this explainer, and never stop learning.